overlaying the US two-year Treasury and the S&P 500. At the bottom, you see the two-year Treasury hourly chart, actually daily chart, and same with the S&P 500 SPX. So the intention of the chart is the red pop-outs. Those show that sudden rise in the interest rate or yield for the US two-year, and corresponding points on the S&P 500 shows that there was a dip around that low. For the S&P, there was a high for that period of time, either same day, a day before, or day after, in the 10-year yield or two-year yield. So you can see that when the Fed admitted the inflation, and uh, it was a convincing evidence that Fed will start to raise the interest rate. So we started to see the dip. The first one happened around here in February 2022, and we formed around 4,408, almost about a drop of 60 basis points. If you consider from the January high around 4,800 to February, during this time, the interest rate for the two-year raised from close to 0.87 to almost to 1.5, and within a month. And the S&P also came down from 4,818 on around January to all the way around February to um, 4,200, so almost 600 basis point. So if you go along this curve, so next one was around, so here, if you see May 12, we formed the NASDAQ low, and a lot of the lows actually, for example, ARKK, the Cathode Growth Investment Fund, that made the year low as of now on that day on May 12, and as long as other NASDAQ growth stocks, as the interest rate just before this day before made a new high of the year at 2.85%. So that means that in 2 year, there's suddenly from 6 months ago almost zero interest rate, it went up to 2.8 to 2% interest rate rise in the matter of like 3 months. So that freaked out the market, and that caused the growth stock sell out and the May 12th low. Following that, there was this constant grinding of this S&P, and the two-year held tight for a while in this tight range, consolidating around the 2.6 level. And suddenly, we had this June CPI release, June 13 CPI release, that shows around 9%, um, close to 9.3% of CPI inflation data. That freaked out the market, anticipating that more Fed hikes, as the Fed was already hawkish, and that brought the interest rate for the two-year all the way up here at 3.39%. To Back in May, it was around 2.85%, and then it went down a little bit, and then all the way up till now June CPI data, and that caused the new market low. So the intraday low was 3636. The market closed slightly above that, and that from the low that kind of held for next few months. Following few, I think from the June 16, we started to see some tech stock and other other stock being bought back, and that caused around August 15, we saw the 20% S&P was up, and that's caused a 50% retracement back from its low around 4,300 level. And at the time, you can see that the interest rate actually was driving towards lower, so around this range, 3.1%. Back in June 16, it was 3.42%, so slightly lower, and that caused also like the until this August 16, when it formed this S&P formed this 200 moving average, touched that level, and then August 16, there was this strong narrative from the Fed in their meeting at the Jackson Hole, that they said that Fed will continue to raise the interest rate, and they referred to Volcker in 1980 when they kept raising the interest rate, causing a recession. So that again freaked out the market. Sell-off started, and that sell-off continued throughout the September. There was a little bit of bounce in September, but then again, there was this talk of the Fed pivot, whether Fed will do 75 basis point, 50 or 25 basis point, but Fed raised 75 basis point, and again around September 21st meeting. Following that, there was a spike on the 2-year Treasury, and then it reached close to the September around the September meeting. It reached around this 4.43%, close to 4.4%, and that caused again a havoc in the interest rate, and that caused a bit of credit crisis in UK. As at the same time, as Fed raises interest rate, the spread of the interest rate is kind of constant across the different central banks, because of this high uh, uh, rise in the two-year yield, and the pound also spiked, and the UK central bank ECB bond as well went up, but that caused the pound to go down. Why? Because although the ECB, the central bank in the UK, raised the interest rate, the new government formed, they caused some stimulus, and they announced some stimulus and also cut some tax. That means that Fed has to continue to hike more in order to uh, reduce the inflation, and that freaked out the market. That caused the pound to drop. That means that pound, that caused uh, and that overall caused this market to come down around 3581, the year low as of now. Finally, the UK government pivoted, and they did back down from their um, tax hike, and finally the market recovered a little bit starting in the Q4. Now market is at 3796 as of October 2nd. So that's kind of the correlation of the 2-year yield and the S&P. Pretty well correlated. As the yield goes higher, we always see that the S&P would dive lower.